Hey there, I'm Marty Cicada, host of Resilient Alpha. You might know me from Ivy Family Office Network. Almost 3 decades of family offices and big shots collaborating on alternative investments, strategy, and good causes. That's the fuel for this podcast. Why Resilient Alpha? Simple. Why do some funds and managers crush it while others crash? We're cracking that code, redefining alpha, and bringing top brains to unpack asset classes and hot alpha ideas. Full throttle. Buckle up and enjoy the ride.
This content is for informational purposes only, should not be taken as legal, business tax, or investment advice, or be used to evaluate any investment or security, and is not directed at any investors or potential investors in any featured fund or deal discussed on this video.
Welcome back to the Resilient Alpha podcast. Today, we're thrilled to have Andreas Calianos, a seasoned financial professional currently serving as outsourced chief investment officer for global family offices, endowments, and foundations at Skepticus Inc. His expertise spans alternative investment strategy, fund and investment due diligence, capital formation, and product development. Andreas Calianos has over 35 years of experience in private equity, real estate, infrastructure, startup, and advisory roles. He is notably associated with Skepticus, a private equity strategy consultancy where he has served as president and chief investment officer, CIO for global family offices, endowments, and foundations. His career spans high-level positions working for endowment managers, global investment banks, and other prominent organizations, showcasing his expertise in structuring investments, managing risk, and generating returns in complex markets. He currently sits on the board of a transportation infrastructure company and a global investment fund. Mr. Calianos has managed billions in assets from Macquarie's Mira division to Dome Equities. And today he'll share his insights on the private equity landscape in 2025. He has been a frequent speaker and writer on capital markets and behavioral finance, contributing to the Journal of Alternative Investments and teaching at venues like MIT's Center for Real Estate and Yale's Endowment Institute. Mr. Calianos emphasizes secure, hard asset income producing portfolios and has highlighted the importance of adapting to volatile markets and accurately predicted the current inflationary environment and the move away from liquid securities to alternatives by family offices. So we're thrilled to have Andreas Calianos, who's a seasoned financial professional currently serving as outsourced chief investment officer for global family offices, endowments, and foundations at Skepticus Inc. His expertise spans alternative investment strategies, funds, investment due diligence, capital formation, and product development. As an aside, Andreas raised a pretty large round once from a Middle Eastern family office. It's kind of legendary how he did it. So he's notably associated with Skepticus, a private equity strategy consultancy where he has served as president and chief investment officer for global family offices, endowments, and foundations. His career spans high-level positions working for endowment managers, global investment banks, and other prominent organizations, showcasing his expertise in structuring investments, managing risk, and generating returns in complex markets. He currently sits on the board of a transportation infrastructure company and a global investment fund. Mr. Calianos has managed billions in assets from Macquarie's Mira division to Dome Equities. And today he'll share his insights on private equity landscape in 2025. He's been a frequent speaker and writer on capital markets and behavioral finance, contributing to the Journal of Alternative Investments and teaching at venues like MIT's Center for Real Estate and Yale's Endowment Institute. Andreas, welcome.
Thank you, Marty. It's great to be here.
Fantastic. I'm going to go through these many questions I have for you. So, Andreas, how do you define alpha in today's market? What's the core philosophy behind Skepticus?
The core philosophy behind Skepticus is to work with our family office clients and our endowment clients in a manner that they don't generate alpha, but they get what they wish to get, that they fulfill their investment objectives, that their investment objectives are realistic and correlate with the market. But the way I define alpha is simple, right? Alpha is if you beat the index with less risk, you've generated alpha. If you beat the index with the same risk, you've generated alpha. Now that makes complete sense for a public money manager. It makes no sense for what we've been talking about. There are no reliable benchmarks. The only one that I'm aware of, the Red Rocks benchmark, is a composite of 60-odd publicly traded global PE companies. And that has little relationship unless you happen to be a fund manager who's managing a public fund. And so the idea of alpha, Marty, in our world really is an idea of what do you want? You're not making relative return bets. You're making absolute return bets. And so I would much rather have a conversation with my clients and counterparties about what they wish to achieve and how they're going to get there than if they beat their brother last week or not.
Perfect. So let's start with the big picture. So private equity saw a rebound in 2024 with $1.7 trillion in global deal volume, yet we're still below the 2021 peak. How do you see the market evolving in 2025, especially with near record levels of dry powder and a potentially softer regulatory environment in this new administration?
A few weeks ago, I may have answered that question differently. I think the uncertainties that are clearly emerging, not only in our own country, but other countries, raise the specter of unexpected things happening. As a simple example, I know guys who for decades have been buying government leased buildings leased to the government. And their simple analysis was, if I can get a yield 200 basis points above the treasury, plus tax benefits, sign here. No one ever suspected that in fact, the premise was that government would never be downsized in those funds and in that execution. That premise has been shown false. And I think private equity is going to continue to win. I think, broadly speaking, private assets that are not marked to market will win over paper assets that are marked to market. When volatility enters the system, where does it go first? It goes into places where you can sell something. And the wonderful thing about private equities is it can't easily be sold. That's actually a benefit. You must be paid for that illiquidity, but I think private equity is going to continue to enjoy big inflows, and not least of which money out of the public markets.
Great. So you've worked with endowments, family offices, institutional investors. What are the key pressures they're facing today, and how are those shaping their appetite for private equity?
So that's a really good question, right? The way to think about these different investors, it's important, is investment horizon. So on a normal day, endowment managers are managing for an indefinite life. Let's take the other extreme. On a normal day, traders might go home flat, have no risk overnight. They're just making their money intraday. So those are two approaches with two extreme time horizons. What's happening in the world now and what's affecting all those classes of investors and what happens when volatility enters any market is time horizons shorten. Everyone kind of tilts forward on their screen. They listen to the news. What did Trump say? Was there another executive? And I think what's happening now is I'm seeing time horizons shorten. And so for the long-term investors, they need to stick to the plan. And for the short-term investors, they need to have probably a lot more volatility tolerance in both public and private, because I don't think the world, I think in a world of rising rates, cramped budgets, and unstable politics in major countries, it's easier for short-term guys to whip markets around and to go from one private equity avenue to another. And I would rather have a long-term view. What's a long-term view these days? 7 to 10 years. If you're going into private equity and your investment horizon is 3 to 4 years, if something goes wrong, it could easily double. So in your mind, if you're doing a 3-year deal, you're going to be thinking 6. And if you're doing a 5-year deal, you're going to be thinking 10.
So
We talked about this last night at dinner about interest rates, and Maxwell Drever actually put out an interesting little tome about him anticipating interest rates are going to stay high for a while. So interest rates have come down slightly. They're like at 4.33% as of late 2024, but they're still higher than the zero rate era. How do you think the higher for longer environment will influence PE investment strategies?
I don't think it's, respectfully, I don't think it's higher for longer. I think it's normal for longer. The quantitative easing that began in 07 and 08 was unprecedented. And remember where we took that phrase. We took that phrase from the Bank of Japan, who was the first to implement long-term quantitative easing, buying assets in 2000 to fight Japan's deflation. And what we're facing today with interest rates is a situation where we've just come through a period, 14-year period, of historically low interest rates. Prior to that, of the US, the longest period of whether it was quantitative easing or significant rate was 1 year of Fed action, 12 months. That was Greenspan in, was it 02 or 03? So we had 14 years. So we've just come through an experiment that our financial system has never, we have no history on what happened and what's happening now. And so I think within the realm of interest rates, they're just going back to a normal level. And we can't underestimate how much interest rate, what it took to bring those interest rates down. The Fed just lowering interest rates didn't work. That's why they had to do quantitative easing. And if you look at the GDP ratios and during those years, the total amount of quantitative easing was just over $2 trillion, which was about 15% of GDP. So we must remember what was done in order to get us to where we are today.
Yeah, I guess one of the fears is the government crowding out entrepreneurialism in business, right? So at Skepticus, you've advised on navigating volatile markets. What's one macro trend you're watching closely that could make or break PE this year?
Okay, the break part's easy. And I hate to say negative things into anyone about anything, but the private credit market is a new market. And very few people really have read the underlying, not fund documents, the underlying documents that run the private credit. And the SEC pulled State Street's Apollo ETF last week, and State Street now going to rename it. Why did that happen? It happened because this is the first private credit, essentially ETF, and it needs to clear the SEC's mandate for liquidity. And if you drill down, nothing against State Street, nothing against Apollo. This is a fund-wide situation. If you drill down, you're going to find terms like mark to credit, not mark to market. You're going to find terms like, you're going to find terms where one division of a company can loan money to another division of a company, of the fund manager, to make interest payments to its own fund. Huh? Why would you do that? Why would you ever do that? You would do that because the deal might be a $20 million deal, but you're in a $15 billion fund. And if you want to keep those fees rolling, you're going to make, as a GP, that credit payment. What is going on now beneath the surface, this is not a universal statement, is extraordinary and has been under the radar until last week.
You know, people say, why do people do it? And I like to think because they can.
Exactly.
Right.
But we also said, well, what, you know, the AI, I learned a lot yesterday with AI. Darwin and the other folks who spoke. I think AI needs to be well understood, but you need to cleave AI, right? There's going to be commodity level AI. Everyone's going to have a blender. Everyone's going to have a dishwasher. I remember when fax machines came up. I'm that old. We all looked at each other. We said, "Do we get a fax? Everyone got a fax machine, right?"
Well, the adoption rate is really fast, right?
Yes.
So,
but the thing is, you have to separate recurrent tasks that are very easy for AI versus really value generating tasks like creativity, which AI is
that's
no
great.
good at.
We're not going to go off script. So we've been talking a lot about this, you and I, on the phone, and actually I talk about this to a lot of people, but there seem to be a lot of crowded trades. And I think people like Suzanne and other people would say, there's a sameness to a lot of the offerings out there, right? So sectors like technology, healthcare, real estate, PE darlings for years. From your experience, which of these feels most overcrowded right now, and what's driving that congestion?
AI infrastructure and I love AI, but AI infrastructure reminds me of a lot of Internet 2000 infrastructure, right? A lot of those firms don't exist anymore. And I think that the AI infrastructure will become a commodity just as internet infrastructure became a commodity. Far more interesting parts of AI aren't the guys building the chips. It's the guys figuring out how to use the chips and make money. That's what I find interesting.
Yeah, it's actually very interesting because Peter Lewis gave a presentation to our group from Morton Equities, and he said a lot of people are building out infrastructure where there's no power, and it takes 5 to 10 years to bring this power online. So it's very problematic, right? So you've seen a lot of real estate cycles, Dome Equities, Macquarie, Russian logistics, power, multifamily. Is it still justified? Are we seeing diminishing returns in those spaces?
You've got to really understand supply and demand dynamics. And you have to really understand the track record of the sponsor. What generated that track record? Oftentimes, so we'll do track record reviews for our clients. We'll bring in some really smart people. And they can tell us, we've often helped fund managers understand where they generate alpha. But oftentimes in the real estate world, a lot of good return comes from 1 or 2 deals that just out of the park. I think there's great opportunity in hard assets. Frankly, I think it's where the most opportunity is. In particular, though, I like areas that solve a big problem. And one of the biggest problems now is state and municipality balance sheets. They're running out of money. They will not be able to afford doing what they do. What's the first thing they're going to cut? Public infrastructure and transportation. And we see great opportunities in a sector like that because there's very few places that people can go to extend their subway networks or to move people from one place to another quickly.
Right. So for the Macquaries of the world or the Brookfields of the world, it's kind of like a gold rush, I would imagine, right? Because
I ran U.S. real estate and U.S. debt for the world's largest infrastructure investor, Macquarie. And I thought I knew what infrastructure was, but oh my God, it's huge. It's just bridges that cost, $60 billion.
there you go.
The bank
I think a
expensive.
mile of subway cost $2 or $3 billion.
Yes.
And I'm going to say that the California train and number has cost $60 billion. They still haven't laid contracts, right? So
And
a
so
lot of planning.
I'm plugging a company. I'm on the board of Swift Rails, but they do point-to-point transportation on an elevated ultralight monorail.
Pay attention to this company. It's going to be interesting.
They make public transportation profitable. Now, is it going to move people from Brooklyn into Midtown? No. But there's a chip fab plant going in upstate New York. $100 billion facility needs to move 32 contractors 3 miles away twice a day. We're going to build that. There's an island in the Caribbean that can't grow any further because getting from the airport to the downtown takes too long. We're going to build a 1.5 mile elevated monorail. Why elevated? Because you're not confined by the existing congested road infrastructure. It's ultra cheap. It's essentially Uber on the rail. It's not a train. You have an app, it comes, it picks you up, takes you where you need to go.
Build a tunnel either.
No tunnels.
Right.
And no road work and 600 MPG.
So private credit has exploded as a PE adjacent play. You spoke a little bit about that. Direct lending has become a go-to. Is this a crowded trade yet, or does it still have room to run given banks pull back from leverage lending?
The bank holdback is really what's driving this, right? Banks aren't fulfilling the role they've historically fulfilled. Private credit has stepped in to fulfill that role. Banks and private credit learned their lessons from 2008. They learned that it costs more money to take a physical asset back than it is to just sell the paper into the market. And I think that there are going to be enormous opportunities in some of these single asset deals and in some of these funds that are holding assets that are really You remember the movie Weekend at Bernie's? So the assets are propped up, but they're not really alive. And there could be great opportunities in buying that paper because those assets are often in very good locations that they were just overbought and horribly mismanaged.
I think this audience has lived through many eras of zombie assets, right? So we see zombie assets, zombie funds, right? And especially right now in the private equity and venture capital space, you're seeing a lot of things that will never go public or have an exit, right? So
it's like Jean-Paul Sartre, no exit.
There you go, right. So what's a contrarian take you have on a sector everyone's piling into right now? Where is the herd missing the mark?
Well, with private credit for sure, but generally speaking, I think most asset classes are vulnerable to bubble dynamics. A lot of liquidity has chased a lot of deals. Institutional investors have gotten involved in private credit, in private equity deals at an increasing rate. Endowments and foundations have figured out they've been missing out, and they need to be part of it. The compelling reason for them to get into it was diversification benefits. I don't know if they're going to be there. If you look at the history of asset classes, we actually have some returns. They tend to go hand in hand. Public tends to lead private, but private follows the way.
Great. So I'm hoping to, I know we're a little bit short on time, but I'm hoping that we can get through some of your ideas on new trades and then do a lightning round with you. So new trades and approaches. So with you've got a lot of crowded trades. What's under the radar? I'm going to tell you something I think is under the radar right now. A lot of universities are going under, and all those assets are being acquired on the cheap by other universities, right? I think that's one crowded trade. I think you named a couple other ones earlier. So name crowded trades under the forget about the crowded trades. What are the under the radar sectors or geographies PE should be targeting? And how do you see technology driven niches like climate tech or AI infrastructure fitting into the PE playbook?
Well, on AI infrastructure, I've already given an opinion. I think it's probably a hugely crowded trade. I view the margins and the entire process of having the capacity to use and generate AI as a commodity. It's not yet one, but just like the internet, it will become one. Relative to the question, by definition, under the radar means contrarian, right? And what's a contrarian? A contrarian is somebody who does what others aren't doing. Most people say they want to be a contrarian, but they aren't. Why? Because if you do it, chances are you're going to be really lonely on the back. And you're going to be, your partners are going to tell you, your wife is going to tell you, your investors are going to tell you, you're going to be really stupid on the sell. And so I remember that some of the best contrarian under the radar plays are where very few people are playing right now. And in that view, as I mentioned, I do like transportation infrastructure, not because it's a burgeoning business, it's because the municipalities and states that support it are not going to be able to support it. And you need to be ready to step into that gap. I think.
Let me ask the question of the audience. If you want to raise your hand and then say it to us, give an example of an under the radar trade that's out there right now. I already mentioned the universities that are all going under and all that assets becoming. Does anybody have any ideas, or are you just keeping this secret for yourself? I know this audience. I know you guys.
And I've got some ideas. I mean,
commercial real estate.
Commercial real estate. Okay.
I would agree, especially retail. And if it makes you puke, I'm even more interested. Not retail in New York, retail elsewhere. And especially neighborhood retail. Very difficult to buy. There are a couple of guys who do it. They do it well. They buy the entire downtown or most of the downtown of a medium-sized or small city, and they run it right. And there are definitely opportunities in commercial real estate. Residential real estate now.
Sports franchising and opportunity zones. It's a big deal from a real estate point of view. Anybody else who has yeah? Okay. Brian Sneaker. Just we're not asking questions. What's a opportunity? You have no, you just had to yell out. I'll say it again. What's an opportunity?
For family offices to invest privately?
That's uncrowded. Yeah.
Oh, uncrowded. Yeah, I would look for private investment arbitrage in venture anyway, because that's what I do. Two examples. Okay. Companies with one woman founder outperform all total male companies by a big margin. They exit a year and a half sooner, they produce better outcomes, they're 2 times more cash efficient. And yet, because 80% of the investors are male, you can get in at a discount. So they're underfunded and undervalued. There's no growth fund that focuses on companies with one female founder and looks at all of them and cherry picks the cream that rises to the top.
Perfect.
That's an arbitrage opportunity.
Okay.
The second one is in Israel. Okay. In Israel, there's a recession of capital because of the conflict. But if you look at the history, every time there's been a conflict in Israel, tech has outperformed every single time. So there's no time like the present to, again, capture growth stage deals coming out of Israel. So those are 2 contrarian plays in the venture world.
Okay, great. So, and by the way, I have Lori King, who's a classmate from Wharton. She's a woman founder. So, Brian, I suggest you talk to her. So actually, we had lunch with Dan Moorhead 3 weeks ago in New York. About half the audience there was from our group. And so I said, why doesn't somebody take all these venture and private equity deals that will never be liquid and turn them into some kind of altcoins? So that way you really benefit from the revenue, because some of them will never exit.
There is one strategic trend that's affecting everything we've talked about and everything we do. Can I just mention that?
Absolutely.
How many people do they believe experienced no inflation at their household last year?
Experienced no inflation?
No household inflation. How many? Not
Oh, no, sorry.
0. How many experienced 3% household inflation last year?
Okay, so I just want to say that for the family office world, inflation is 10 to 20%.
Thank you. The Bureau of Labor Statistics said in the year ending 2024, last year, for urban consumers, inflation was 2.9%. I don't need to tell you what the Boston Commission did in the 1980s and how they've redesigned the CPI. I could go into all the technical. I went down to Washington.
We've gone through it. It's a group.
But the point is this: if whatever we're thinking inflation is, it isn't. And what would happen to your portfolios if the CPI next week revised everything and said, "Oh no, it wasn't 3%, it was 7%."
A great example of this is that in Florida right now, because of these new laws on buildings that are 30 years old, the average person has to set aside $100,000 over the next 3 years for their HOAs, which nobody on a fixed income has ever predicted. So, I think there's 1,400 buildings in Florida that are now uninsurable, right?
Good thing old people don't live in Florida.
There you go, right? So, so that's many thousands of apartments. So, let's talk about secondaries for 1 minute. A lot of continuation funds. We had on one of the largest secondaries funds in the world come and speak about 3 or 4 months ago in New York, and they said that more than half of their investments are going into continuation funds. What are your thoughts? What do you think about continuation funds?
In terms of extending secondaries?
I'm not a fan, so you have to tell me why you gave me the question.
You gave me the question. I'm not a big fan of secondaries.
Fantastic. Fantastic. Okay, questions answered. We're going to do a lightning round. Okay. Biggest mistake new fund or deal sponsors make?
Setting expectations far too high and not communicating the true risks.
Most underrated adjacent asset class for business sector right now?
And I have to give a shout out to Paul Sinelli for this one because they help us structure the deal.
Shout out.
And I got to tell you, over the holidays, family office that I do that comes to me occasionally, and they had a almost 10-figure equity investment, 8-figure equity investment that they're going to get crushed on, restructured the equity to debt, had to get an intercreditor agreement signed with someone who didn't have an address. I can't say enough good things about the Paul Snelly law firm. They stepped in over the holidays, made the impossible possible. What was the question?
We'll be putting that out on LinkedIn as a promotion. That's $10,000, Pete. Thanks. Anyway, boring trades adjacent to popular asset classes.
Boring trades, picking up the mortgage on an operating industrial building that's being sold 70 cents on the dollar, and you've got a leasing broker in hand. I mean, there are deals like this all day long.
Okay, mortgages have been working in the cannabis space forever, right?
Yes.
If you can invest in one innovation today that would help your marketplace or fund sponsorship efforts, what would it be?
Invest in what?
In one innovation today.
Oh, the biggest innovation I can see is the human AI interface. I'm not talking cyborgs. I'm talking using this technology to create new stuff. In 1970, we put 2% of GDP into basic research, brought us gene editing, brought us the internet, brought us all kinds of innovations. We are now less than a quarter of that. We're less than 0.5% of GDP going into basic research. And so where's the innovation going to come from? Everything we've been talking about runs on innovation. It's going to come from leveraging AI in a creative, innovative way. And I don't have the answer for this yet. We're beginning to try and write patents using AI, or at least guide us to the space in the patent area where we think we can have a defensible patent. But that creativity and innovation by a human or teams of humans working with AIs, where AI isn't answering the question, but AI is giving you the right question to ask.
Time's up. Favorite financial metric to analyze when evaluating a deal or trade?
Free cash flow.
Anybody else have a favorite financial metric outside of free cash flow? Great. I like to look at a lot of different things myself. So, most surprising deal or trade trend in the past year?
I don't think it's going to happen, but making private credit public.
Advice you'd give to someone entering your sector?
Read your history. I'm a fan of behavioral finance. Markets go to extremes. It's what we do. It's what all of us do. We take markets from one extreme to another. That's what we do.
It really is. Any books that you've read on that topic?
The best book was Professor Emeritus of Economics at MIT, Charlie Kindleberger. He took me under his wing. Manias, Panics, and Crashes has direct evidence, direct applicability to today. It's always the same thing. It's human psychology and debt.
Biggest challenge facing alternative investment sponsors in the next 5 years?
Meeting their return and claimed and as of yet unevidenced diversification objectives. Why? Because diversification is what's going to get the institutions in and keep them in.
When you look at the massive change that you've seen or anticipate, what are the characteristics of those changes you continue to look for in a future investment?
I don't want, I'm a like a Yogi Berra contrarian, right? Nobody goes there anymore because it's too crowded. And I think people need to be very good at being comfortable with what people aren't in. It's really easy to jump in the pool. It's a whole lot more difficult, but the real return and the measurable risk live in areas that are not crowded.
Okay, we've got time for questions from the audience. I've got time for a couple of questions. Steve? And it's lightning round questions. Perfect.
Cost of capital and the relationship between debt and equity in any transaction affects returns. To what extent do you believe that the debt situation in this country and its interest rates impact that or will impact it going forward, and to what extent, in what way, positive, negative, et cetera, depending on the results?
Andreas, government debt, thoughts?
I was going to say, relationship banking's gone, really, right? And that's something private credit has been unable to duplicate. When you had a great relationship with your money center bank for your real estate lending, your tenant improvements, right? You go in and it's a revolving door of capital. I don't see that happening on the private credit side. I think it's going to hurt hard assets in terms of being able to get relationship capital. In terms of interest rates, it's going to be if I knew where interest rates were going, we'd be having this conversation on my yacht, but I don't. And, but the
Great.
pressure is certainly up.
Lightning round answers. Another question? Another question? Where's the next question?
This is a very short answer. $10 billion family office has half of its capital in private equity and venture, of which 700 million is in venture. That's their current allocation. Should they increase that allocation? Should they keep it steady? And how does that play out for smaller family offices that might have 100 million under management?
That's like asking me how much I weigh, not knowing my height. I don't know really, what level are they? You could be in the same asset class, the same industry, even the same sponsor, and depending on the vehicle that you're in, have extraordinarily different risks. And
Everything is situational and depends on your risk appetite, right?
The crypto industry has spent a lot of money this past election. President supports the business. Where are you on that?
On crypto.
Well, as I mentioned yesterday, a friend of ours told me to buy $5,000 of Bitcoin. I think it was a decade ago, so I didn't do that. I think the stable coins, as I'm coming to understand them, are interesting. But look at I think volatility communicates information. And when you look at the volatility in these tradable cryptos, that's telling you something. I mean, it's not a stable vehicle. And I don't know what that means for the future of crypto.
I guess I asked this question yesterday. Who thinks that Bitcoin will be up 10x in the next 10 years? Besides Mitch? You are a crypto guy. Okay, 4. And how many people think it'll be down 10x in the next 10 years? How many think it'll be up 10x and down 10x in the next 10 years? Great, fantastic.
What I would bet on is the blockchain technology, because that is still, I have never seen anything more secure than that.
I know Alan Patrikoff is here, and I know Ron Conway and one of his old partners, Bob Bozeman, and he said to me once, Bob said, a lot of times tech has its periods where it's new and that's interesting. And then once it becomes commoditized, it's not interesting anymore from a venture capital point of view. So I'm wondering if some assets of blockchain have become commoditized since AI can generate blockchain. So, but Andreas, I think we got to wrap because I got to go to Elizabeth and then we have Alan afterwards. So thank you so much.
Thank you.
Great job.